kindness. So the last presentation is from Rasmus and Jonas. They work at Deloitte. Rasmus is a director in Deloitte Danish consulting practice. He has 6 years of experience in managing a blockchain project. He have managed more than 30 projects, and Jonas is a senior manager in Deloitte. He obtained his industrial PhD at Copenhagen Business School, and he advises clients with technology-driven changes to strategy and business model. And in his PhD thesis, he investigates blockchain technology, impact on accounting. And so day to day present a work on the impact and the role of CFOs in a collaborative future. Thank you.
All right. So before Rasmus starts, I want to invite you all to look around in the room and maybe find a face that you haven't connected with yet. Because this presentation is all about collaboration. So you might start just finding someone that you didn't know and look them in the eyes and say, okay, so we're gonna meet up, and maybe if we are to really gonna change this profession, it's gonna be a common thing. So 1 minute, look around, and then find someone that you might want to collaborate with in the future. Okay? Okay, Rasmus, go on.
Maybe that was too big an ask. In sort of when we are keeping you for getting out in the good weather, that's a tough one. I think just a disclaimer. Everything that we will say in this presentation is not a official opinion made by Deloitte. It is an opinion coming out of our mindset and way of thinking. Just that's put on record. So we should be good. We should have had it on the slide. The second thing I would say, I want to come clear. I'm not an auditor. I haven't worked with financial systems. I'm not from this profession by any means. However, if I'm successful with this presentation, having no knowledge, I will show you how you can become an expert. And maybe that's also something that we would need more of. At least that's what we are seeing when we are having discussions with executives on what will the future hold. So the entire topic of what we will discuss now is how do we see the role of the CFO into the future, and what is it that we think is changing? So we have divided into 4 different sections, sort of the shaping forces, what we perceive is coming. Then we have a bit of data collection. It's not as thorough as the academic research being presented throughout the day, but at least it might give us some discussion points, and please do just ask questions afterwards. And then we'll go into what does it mean to have a collaborative mindset. It is actually a difficult thing, because what you have learned in business school is to have a competitive mindset. And that's the opposite thing. And then we'll open the floor for questions, and that would be the most exciting part. So we will fast track into it. So when we're discussing this around shaping forces of collaboration, I think we see 3 things as driving this towards a different paradigm, you could call it. One thing is what we have seen with external shocks, with the COVID, climate crisis, we have the geopolitical tension. All of this is putting pressure on, we also heard that earlier today, on sort of that collaborative nature of government together with private actors, that in terms of a crisis, we might need something different than being lean and efficient. We might need resilience. And the climate crisis, I think, is something, at least when we look into younger generation, that is a really, 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 really big concern, and something that we will not be able to solve on our own either as individuals, nor as companies, nor as just societies. It would require a collaborative effort. And that's sort of shaping one thing. On the other hand, we also see regulation pushing towards this. And if we're just to pinpoint part of this, we also had presentations on great presentations on how to do ESG reporting, trying to facilitate that. And I think when you look at a scope 3 emission, there is something there where if we are trying to solve this one by one, we will have an issue of accounting, because if you are accounting for the entire sort of value chain, how do we then remove that we don't double account for everything every time something passes along? So we need to have some sort of regulation in place. We need to also have clarity on this. And I think that also calls in to sort of, we need to find a new value definition on what makes sense. And if you are a CFO right now, what we see with a lot of the CFOs are also the notion of not just having a profit optimization. You would need to have a sustainability optimization, a future-proof business, a resilient business that comes out of not just being compliant, but also redefining your purpose and how you drive value out of it. And then I think the last one is the digitalization. And we've heard a number of sort of new emerging technologies that is coming, that is shaping up, and I think everyone has been surprised over what has happened with AI over the last 9 months. And I think this is just speeding up, but there is something to digitalization where we also need to stop up and think of, do we have the right structure? For example, what we have seen with the internet is really good at distributing information. However, if we want to keep assets and we would like to have certainty of that data, we need to make sure that we're not exchanging copy of data. The discussion around the synthetic data is also interesting. And therefore, I think we should look to digitalization also not just as efficiency optimization, but new ways of trying to do collaboration. So all of this is something impacting the CFO, and if you are in the mind of the CFO, you need to navigate this and put forward something that makes sense for you and your organization. So on I think it's a quarterly basis, we have a survey that is going out to CFOs, and part of what we are asking them on is what keeps you up at night, either from an internal or an external perspective. And what you see on sort of the internal side of it, there is if we showed you what it looked like 6 months ago, something like pricing would be on the very high, because inflation, what should we do? Should we increase pricing? What is sort of all the issues around that? That has sort of dropped now, but what we see now is on the talent agenda. And it's on the sort of change management, the ability to tap into all the changes that needs to happen. And can we attract enough people, the right people, to this? I think also that there are some notions in this that if you're a small company, how can you attract the right people? Or do you need to collaborate with someone having that insight and then figuring out new ways of solving your task? On the external risk side, what we see is, of course, geopolitical and the instability still being sort of the main topic. Inflation is a concern. Is it going up and down? However, that has dropped. But we also see some of the financial interest rates, etc. And then, of course, keeping up with regulation and policies. So this is what keeps them up at night when you look at it from the CFO perspective. But I think part of the issue is that the CFO is one part of the executive. And what we also are seeing is something is changing when it comes to sort of the lifetime of a company. We see new companies popping up, old companies dropping to near zero market cap. because it's difficult to keep up with the change coming out of technology. So when we are trying to advise on how do you keep up with these changes, we try to put this innovation into the perspective of this model, and it's actually pretty simple. On the one side, we have where to play, so that's what are you bringing to the market, and then the other part is how do you do that? How do you win? How do you outbeat your competition? And there is a tendency that people focus on the core, because that's something that you already are doing, something that is known, something that you can go out and test and validate with your customers, your market. And if you're a bit more sort of explorative, you would go to the adjacent area where you punch in a new sort of technology, trying to do the same thing, but you can do it faster, smarter. What you present with the auditors is also the notion that if we can improve the efficiency. We also heard Miklos earlier today trying to make it more efficient, but we really aren't changing the game, the structural game of doing things. Thereby, we need to go up to the transformational. There we are changing the game with new technology, but also coming with a completely new mindset. And I think this is difficult, not only just for CFOs, it's difficult for most professionals. Having no audit knowledge and no affiliation with your, this is the first time being part of this group. What I find interesting is that you're looking towards a lot of effort into optimizing out of the same core principle of what you do today and see if we can do that smarter. But if we need to rethink or re-engineer something, we shouldn't start with the offset that we have today. We should start with a beginner's mindset. We should start with something where we are interested in redefining it or learning. So what we see here in this model, there is sort of a above and below the line. Below the line is where most people and professions feel most comfortable, where we are in control of our risk. We are trying to reduce risk, we are trying to control it, we're trying to mitigate it. But when we move up to uncertainty, the unknown and unknowable space, that is difficult. Because how do you do that? If no one had tried it before, what do you do? Part of Jonas's work in Deloitte is, on the one hand side, helping our clients navigating these uncertainties. On the other hand side, we also do this internally. Let me just say that trying to convince our own auditors in moving upwards is extremely difficult, because uncertainty also means that you don't have the answers. It means that you need to ask the questions. I say playing in the domain of uncertainty is like playing poker. So if you have a Texas Hold'em, you have 3 cards and you don't know what the others are having. Having no perfect knowledge from a risk perspective, you should fold. But then you will end up losing. You would need to play around to learn more. Doing that in small iterative ways would allow you to have a different mindset. And this is uncomfortable for most people, but this is where we need to have, and a lot of this calls for that you need to look towards what others are doing in other sectors, other industries, where you might get some pointers towards what could we be looking for when it comes to this. And also the notion is that normally we would think that we know best, and the CFO would also say that, yeah, we know our business model, we know how we earn money. I mean, in the consultancy and audit practice, spending another hour at our clients is good for us, at least. Maybe not for the clients, because they would need to pay us. But if we need to do something different, we also need to make sure that we let go of that risk aversion and enter into the uncertainty. And there is a need for thinking different. when it comes to. I think moving towards that, it would make sense to have a look at how business model can impact this.
Yeah, and I think also reflecting on this as being part of this academic environment during my PhD, I learned that publishing in the AIS field is looked at as kind of inferior compared to the more kind of traditional things. So trying to kind of change the game and learning from other industries, CFO could actually understand how technology drives shifts in business models, and therefore also anticipate how the collaboration models of the future actually look like. What we have done here is that taking a look into the gaming industry. And normally gaming industry, they're quite far out, and we can see that their business model has actually evolved with the development of technology. If any one of you have ever played The Sims or Call of Duty, anyone done that? Yeah, okay, come on, Riz. Some people have done that, right? So when you started that, you went down to GameStop and then you bought a game and then you start playing, right? That was pretty simple, even though it was a bit expensive. That was how it was. Then later on, when the internet and bandwidth became ubiquitous, it was more of how could we actually ensure that we got as many people onto our game, and then have microtransactions actually kind of being the driver. So for example, today if I want to play some game on my Candy Crush or what I have here, Clash of Clans, it's free, right? So you want to remove the barrier of entry, and then you sell these incremental things. It's what's called pay to win here. However, what we see with the introduction of blockchain here, the new evolution of the internet and the evolution of digital assets, we actually see a new emerging business model. So it's called play to earn. And I don't know if you have followed the Axie Infinity case. So it's a small, well, not a small game. It's a game where that has emerged in the Philippines. And what they do is that the amount of hours that you put into the game earns you these cryptocurrency rewards. And what you can do with them is actually you can exchange them into other cryptocurrencies, or you can exchange them into fiat currency. So and in this case, you actually see, and talking about Michael talking about incentives before, here you see a evolution of business model that is more and more tailored and designed towards incentive structures, and these incentive structures is definitely also networks of collaboration. So going back to the research presented by the lady who was sitting here talking about, well, there weren't any real incentive structures to actually collaborate. CFOs and other business development personnel can actually begin to utilize Web3 technologies to actually build incentive structures, not only inside the company, but outside of the company, making sure that whatever we do, we can actually build incentives to earn something, to reward someone. And if you haven't looked into this, I think it's a fascinating study, and whatever business or organization that you represent today, there are some great learnings from this. And of course, it's not all just tomorrow it's gonna be the same, but there are some interesting learnings, and especially the CFOs that we talk with, their mindset is beginning to shifting towards not only internal collaboration with other business partners, but also how do we collaborate on a trustless architecture, because what the blockchain here offers is actually the accounting beside two firms, not only in my SAP system, not only within my own processes, but the collaboration between companies. So I think that's quite crucial. So as we put out in the beginning, we need to shift the value paradigm. Shift it from a shareholder perspective to also include all of the others. So in the beginning of the 2000s, Deloitte created what was called the enterprise value map. So meaning that whatever task that an enterprise was doing, they were focused on either growth or cost reduction or kind of having this shareholder value mindset. However, just released in the beginning of March this year, we have now developed, so we also include the ESG factors. So go on to Deloitte.com and explore these new value drivers, because at some point we will have a tax on the environmental impact that we do. So in the future, this is also going to be some kind of economic instrument that we are going to be able to deal with, and the value creation needs to be more holistic. So just pointing that. Yes. And here, since we are in the audit realm and in the accounting realm, I need to talk a bit about Kaplan. So Kaplan is the inventor, as many of you know, as the activity-based costing and balanced scorecard. And late 2021, he came up with what's called the e-liability framework. And it's quite interesting because it's a critique of the scope 1, 2, and 3, especially the scope 3 emission accounting way of doing it. But what he proposes is actually quite simple. So he, of course, uses the language of an of an accountant, and he says that if we are to deal with scope 3 accounting, we should create what he is calling an environmental liability. So as the same as we would do with in our invoice, we pass on the cost somehow because we have a price, and in that there is calculated the cost somehow, and then we pass on to our customer, who then pays for it, hopefully gaining some value. At the same token here, he says that if we are to account for the emission that a product has emitted through its entire life cycle, we need to pass on that environmental liability to the next party in the chain. So he proposes that doing that, we should use what he describes here as an environmental liability, and he actually proposes blockchain to be that intercompany general ledger. And it's quite interesting because then at the end of the day, when the consumer actually pays for the product, he or she will know what the entire environmental footprint has been. And of course, there's a lot of issues with how do we actually control that the production has obtained so much CO2 and so on and so forth. But he actually comes up with a theoretic contribution here, trying to solve for the scope 3 emission. But it requires collaboration. So I think that's also key here.
And I think also looking at what's coming in the European Union with the sort of digital product passport, where for some 4 different categories in not a distant future, you would need to have a product lifecycle management. So unique serialized products, where you would need to be able to follow the entire footprint, environmental footprint of that product throughout the life cycle. We would need some sort of new way for accounting that, because doing that in each and every individual silo of the one holding responsibility simply isn't good enough. So when we're discussing this together with our in Denmark, the Danish Business Authority, they are part of trying to figure out what would be the right way of doing this. The old ways of thinking, exchange of finance information simply don't apply, because that's company towards a legislature and with an order in as an intermediary trying to verify that this is valid. But this is drawing a new timeline, a timeline of a product, not a timeline of financial transaction, and it's different. And it needs to be accounted for every single time someone passes on something. So for this, you would need a new infrastructure, a new mindset. And I think there is something to this where you cannot apply the old ways of doing it. What we see a lot with the ESG reporting or the business model is that we try to drag all the opportunities into the legacy mindset of what we always have been doing, instead of coming with a beginner's mindset, trying to say, if we would do this the right way or the simplest way, how would we then construct it? But that will require that you don't know what you are doing today. So when we try to change the mindset of our auditors into something different, then the knowledge is actually the biggest liability that we need to resolve, or the biggest issue that we need to resolve. So that's part of the problem. Time-wise, I think, you are in control.
Thank you very much. You are just 5 o'clock. So we have 5 minutes for question and curiosity and suggestions.
I would be disappointed if you didn't have anything to say, Michael.
Looking at that chart from HBR, do you think the one person is capable of doing all 3 of those things?
So that's a good question, and when you look at the actually there are also some numbers on this, and the average distribution. So what this study did was that they asked and mapped the innovation effort in companies, and what they did, they wanted to map them into these categories. They found a 7-20-10 distribution of the allocation of capital, but 5 years later they found that the return was the inverse. So that means that return from the transformational efforts that they actually got was 70% of it, which tells, and this is what, now 10 years old or something like that, it tells, at least the conclusion of that study is that you need to take a balanced and a portfolio approach towards your innovation effort, because you will not know which of the transformational projects that actually pays off. However, data suggests that there is a high return on investment, but it also says that you shouldn't, of course, not reject the core, but you shouldn't only be at the core.
But I also think that what we see when above and below the line, the traditional CFO really thrives. That really makes sense. Above the line is different, because it's different. It's a different metric that you would need to apply if you want to control that portfolio. We also do see the move away from creating maybe a return on investment, where you then more look into economics, coming again from that sort of in the gaming industry, where we see this transition toward play to earn. That requires that you can incentivize people to join and keep them there, and even make sure that the time and effort that they put in is not just being fun and entertaining, but something that derives a value, and that you can create a market for whatever kind of things is coming out of that. The that's economics. That's a full-fledged economic system that you need to think of. And I think that is somewhat different than just looking at a business case where you're saying money in, efficiency, cost savings, benefits, perfect. So the complexity here is it's a different mindset. And I think also a lot of what we are seeing is that you need to include people with other perspectives than what you have already. I think that's the crucial part. You would need a broader set of skill set around the table. Otherwise, you won't succeed, especially not above the line. A super question, but what we see, the CFO holds the money, so he can say no. And if you're risk adverse, the easiest thing is to say no. So if you don't hold that sort of innovative mindset, you should make sure that you don't get in the way of saying no to things. So it might not be you taking on that role, but you should also make sure that you're not putting obstacles for others trying to pave that way. So there you need to strike the balance.
I think, part of what I was going to say, Michael's already said it, but if you look at what was coming out in the 1990s from Hollander, Dana and Cherrington, where they talked about the new knowledge professional, was it they used the term? Where they were talking about a new form of accountant, a different personality, someone who wasn't risk averse, who was an advisor, who gave the best advice in the circumstances but wasn't tied by their own beliefs in the way we are. Really what you're proposing is, I'm reading this as a suggestion that we need to repopulate the accounting profession or the accountant in business with different thinkers, with people who are not the traditional pragmatic, risk-averse individuals. Now, how do you propose we do that? Do we get rid of the role of the CFO altogether and invent something completely new, which isn't fixated on our ROCE? What's the solution to it?
I think we met a company not that long ago that had no CFO. They saw the control of the CFO only as an added cost, because what they were able to do, they had a sort of a garment cleaning model. So for hospitals, beds, hotels, etc., they would do the cleaning of all the garments, and everything was digitalized with an RFID chip, with a reader, something like this. This is a small IoT device that is a sticker. It holds no battery, but it's active. It can send Bluetooth signals. It can go into your washing machine, and it can communicate with its surroundings. It can say how hot am I in a polluted environment, etc., etc. So they have been able to standardize their sort of core operation and digitalize it, meaning that they didn't need any CFO. It was IT people doing that. Doing their sustainability reporting was something that they could do down to the unit level, because they had that digitalization of every single step throughout their value chain, for pricing, for reporting, etc. So that's all the finance part. Of course, they need to comply with regulatory, but they saw that as being an added cost that didn't hold any value. But what did hold value was the digitalization and paving the way for trying to solve this. But that was the IT and the marketing. So I think there is something to this. And of course, when you're saying then, if you look at from the audit profession, how much do we need to change the mindset of the auditors? At least everything that is rule-based can and should be fully automated. But there is within our industry also there is not a an incentive to do so because we are making money per the hour. So that really that would call for regulation if we were to do something like that. I think the industry wouldn't do that on its own, but at a point someone else would come and do it. And I mean, if we had an exercise with some of our executives a couple of weeks back where we said, what would happen if Elon Musk had a grudge against Deloitte and auditors and decided to do what would be needed in order to make us obsolete? How would he do it? Saying there is no restriction on budget, technology, etc. How would he do it? And I think the striking thing is that more or less everyone in the room agreed that 80% of what we do could be rule-based, automated, and removed. And that's kind of crazy. And we see, I mean, is that then coming? But we have seen it in other industries, and we shouldn't close our eyes towards that. But I think that would also call for, I mean, whatever academics research being published, how much can we remove if we started in another way? I mean, why on earth are we trying to do accounting on what happens inside an organization when the real value is what happens in the exchange between two organizations? An invoice isn't, in my opinion, it shouldn't be allowed to be a legal document up until the point that it's really valid and being validated by buyer and seller and being fulfilled. Up until that is just communication, like any other communication, and it's nice, it is woo. But the real value is when something real happens, and that happens in between. But that also means that we would need then a ledger to control what happens between organizations, instead of trying to reconcile all the silos. That's a different paradigm. Also something that I don't get applause for when we present it. There are more question marks, but I think that would be a different paradigm coming with. And then what's keeping us for not doing that?
And I mean, from a theoretical point of view, Bill McCarthy introduced the REA, accounting ontology, in '82. And basically that's a vehicle to actually have a theoretical vehicle to solve for what Rasmus is actually doing, because he is focusing on the transaction between actors rather than focusing on accounting or registry of where the transaction happened within the ERP systems or books of the firm. So it's out there, it's just not used.
That would call for why it's not being used, because it's not the normal practice of what we do, because we start dragging everything into what we're used to doing, instead of coming with the beginner's mindset of trying to do it differently.
All right, time for sangria. Sorry.
Okay. Thank you very much to all the presenters, for the speakers, for their interesting presentation. Thank you to you all for attending this third session until the end. Just an advice for people who will participate to the dinner, conference dinner. The meeting point is Plaza di Sant'Anna, around about 7:30. So thank you very much again, and enjoy your evening.